Well, hello, this is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. We have been explicating test specifications, content outlines. We have completed the explication of the SIE. We're currently in critical function 4 of the Series 7. And we will begin our explication today on the Series 65. So highly recommend you print this PDF out. You can get it on the NASA website. I would use it as an intellectual inventory as you go through your study effort. I don't know, if I were a student, maybe I use this as a preview of what when I'm reading and watching videos, whoever your study materials come from, give you a better idea what you should be looking for. These aren't a substitute for the actual lectures I have on the channel for you. They're not a substitute for your study manual from Kaplan or Knopfman or STC or Solomon or Past Perfect, but just give you a general understanding of what you need to intellectually own for your test. So, all right, let's get started on this explication. The game plan here today is to do this first section here, basic economic concepts, 6 questions on your 65. And then get financial reporting done. And then we'll call it an explication. That'll be our first down payment on working our way through this whole document. Later on, very shortly, I will have the second part, which is analytical tools. So when you see this, you'll know coming shortly will be the next segment. All right, so let's get started. So business cycles, what you're going to get tested on here is what is the definition of a recession. A recession, test question, can best be described as 2 calendar quarters of declining GDP. And declining GDP and a depression. Test question, a depression can best be described as 6 calendar quarters of declining GDP. I would know the definition of GDP. The GDP is the total goods and services an economy produces. Monetary policy, very, very testable in fiscal policy. So first thing you need to know about is who does monetary policy. It's the Federal Reserve Board. And the Federal Reserve Board is our central bank. So it's the Federal Reserve Board. And they have 2 mandates. They are interested in price stability or price equilibrium and full employment. And price stability means the Federal Reserve Board doesn't want inflation. That's too much money chasing too few goods. And they don't want deflation. Deflation is too many goods and not enough money. They want to have just the right amount of money in the economy, right? So the tools they have of the Fed, let me get rid of fiscal policy so we don't mess that up. Right now we're talking about monetary policy. And let me put down here fiscal policy, because we certainly don't want to forget to talk about that. I'll just call that this one. I'll put it here. There we go. Now we got some little separation here. Okay. One tool of the Fed is what's called the reserve requirement. So the Fed tells banks how much they have to keep in their till to meet everyday demands for deposit. And so you have to meet this reserve requirement every night. And if you're a member bank of the Federal Reserve System and you don't have the reserves you need, you can borrow it from a bank with excess reserves. So banks with deficient reserves borrowing from banks with excess reserves is Fed funds. That's testable. And Fed funds is not set directly by the Fed. The Fed targets that. They don't set it. And Fed funds, of all the rates you're held accountable for, you're held accountable for 4 rates. But this is the most volatile, meaning it changes the most often. Changes the most often. Now, the other thing that the Fed can do, if you can't borrow this money as a bank from the Fed, you can borrow it from, can't borrow from a fellow bank, you can get it directly from the Fed. And that's called the discount rate. That is set directly by the Fed. And the discount rate is from the Fed, Federal Reserve Board, from the FRB to banks. Now, usually the Fed is going to want some kind of a, collateral, for that. The other tool, so the tool of the Fed, the one reserve requirement, let's just put the tools, their tool is controlling interest rates. And so one thing the Fed can do if they're trying to, ignite the animal spirits, as Lord John Maynard Keynes said, is they could lower the reserve requirement, telling banks they don't have to have as much as reserve to meet their everyday demand for banking. And by lowering that reserve requirement, that means there's more money available. So the money supply goes up. And then most importantly, interest rates go down. Anybody ever asked you about, finance or economics or investments, you should say it has a lot to do with interest rates. And if you just shut up, you sound pretty good. Now, the thing, Fed thinks things are too fast and loose. They can raise the reserve requirement. And by raising the reserve requirement, that means banks have less money to lend. So the money supply goes down. Oh, looks like here we forgot to put up. Money supply goes up. And here, if we raise the reserve requirement, the money supply goes down. Less money available, so you might have to pay more for it, and interest rates should go up. That's what they do to slow down the economy. One of our famous Federal Reserve Board guys said, the Fed's job is to take the punch bowl away just before the party gets rolling. I'm coming to you here. Who knows? The internet is forever. I'm going to you in 2021 in June. And, the Fed says they're not worried about igniting inflation because they know how to fight it with the tools they have. So we'll say we're going to worry about that a little later. Right now, we got other things. They're focusing on right now more full employment. All right. So another tool of the Fed, and the one that you use most often, is the Federal Reserve Board Open Market Committee. The Federal Reserve Board buys and sells government securities. As I told you right now, I'm coming to you from June of 2021. And right now, the Fed has been buying $120 billion a month of securities. So when the Fed buys government securities, you want to sound like a player, buys govies, the money supply goes up, there's more money available, and interest rates go down. And, it's all about the interest rates and the tools of the Fed, right? If the Fed sells government securities, so they've said not anytime soon are they going to reverse course here. But when they do, when they sell govies, government securities, think about when they sell, the securities go out and the money comes in. So the money supply goes down. That's what monetary policy is, the money supply. And we said they don't have too much or too little. And so the money supply goes down and interest rates go up. So that's monetary policy. Let's just review real quick. Who's in charge of monetary policy? The Federal Reserve Board. We said they got 2 mandates, price stability and full employment. We said price stability or price equilibrium means they don't want to have too much money floating around or too little money floating around. They want just the right amount. And then we talked about tools of the Fed. We said right now the Fed is, fighting not inflation, but full employment. And we said that would be inflation is bad, deflation is bad. I would add a note here. Stocks do better than other investments in this kind of environment. Sometimes on your test, they might say, what's the best inflation hedge? And that would be, stocks. And here, fixed income investments do better. Or I could do vice versa, right? Stocks do worse in deflation and, fixed income do bad in inflation. So either version of that. We talked about the reserve requirement. We talked about how they intervened through their Federal Reserve Open Market Committee. And we said the effect that would have on interest rates. Now, the other thing you get tested on is fiscal policy. And fiscal policy test question is government spending and taxation. Let me get a different color highlighter here. That is most certainly testable. And that's controlled by Congress and the president. That's testable. And one thing you have with fiscal policy is what's called legislative risk. What Congress giveth, Congress can taketh away, right? So, right now they're talking about all kinds of legislative risk in terms of investments. Formerly a dividend of one corporation paid to another corporation was 70% tax excludable. Now it's 50%. So, Mr. Buffett has a position in Bank of America that's paying him $720 million in dividends. 360 is now tax excludable. It used to be 70%. So what did he experience there? He experienced legislative risk. That is testable to know any investment that has any kind of a tax advantage, like a Roth IRA, for example. Senator Roth is not here to protect it any longer. So, Congress may change that the Roth. Life insurance has some tax advantages. So any investment with tax advantages, what Congress giveth, Congress can taketh away. Global and geopolitical factors. They like to ask you about currency valuation. What they like to ask you about is the dollar going up or the dollar going down. Now, that's an irrelevant conversation unless I tell you in relationship to what, right? So, one thing that we can talk about, though I don't know why, but they seem to like the dollar going down more than on the test. Goes down. That's going to make imports, or I should say U.S. exports, more competitive. Because if I'm Boeing and I'm selling my planes and the yen is going up and the dollar is going down, I need less yen to get the same number of dollars coming back to Seattle. So that makes U.S. exports more competitive, and it makes U.S. imports less competitive. Right, because now if you're selling your products in the U.S., and you're the Japanese, right? You got to raise the price on your cars to get the same number of yen going back to Japan. So that's the one they like on the test. The dollar goes up. I'll use the peso, for example. I go to Mexico quite a bit. Used to be 10 pesos to get a dollar. Now it's 20 pesos to get a dollar. So now, that's not going to be good for me if I'm selling my products to my Mexican friends, because they're going to have to come up with twice as many pesos as they used to. So when the dollar goes up, U.S. exports are less competitive, and U.S. imports are more competitive. My tequila is half price, right? What used to take me, $40 to buy a bottle of tequila now takes me 20, right? Because my Mexican friends, I give them $20, they get 40 pesos. When I used to give them $20, they got 200 pesos, right? So when dollar goes up, U.S. exports are less competitive and U.S. imports are more competitive. As a guy who likes economics, some people like it, some people don't. Has famously been called the dismal science, but the test is prejudicial too, because they want this to be, they say this is good because it helps with the trade deficit. In fact, we might end up with a trade surplus, and they are, all about that being good on the test. So, trade deficit is reduced, or we might even go into a trade surplus. And that's a good thing according to the test. Here, U.S. imports are less competitive. That's going to be bad for test purposes. Bad because, again, what will happen here now is we're going to be importing, in my example, more tequila, right? So that's going to be bad in terms of the balance of trade. All this, by the way, is called the balance of trade. So let's just put that up here, the balance of trade. Because now, again, it's going to have the opposite effect, right? It's going to create, or could create, trade deficit reduced here. So now the trade deficit might go up. Let's put that might increase the trade deficit and or balance of trade. Bad for the balance of trade, might increase the deficit or put us in a trade deficit, either, reduce it or have it be a trade deficit. And as I said, that's kind of prejudicial. That's bad, right? The test has a prejudicial thing that U.S. exports are good and U.S. imports are bad in terms of the balance of trade. Trade surpluses are good. Trade deficits are not. So, ride the horse in the direction it's going, right? Exchange rates. Well, we kind of talked about this already, but, if you are making investments in some other place, Mexico, Japan, Europe, you're going to have to turn the euros or Swiss francs or British pounds or pesos or, yen back into dollars. And so that can definitely affect your return. Some people don't understand that. I had a guy who was bragging how much he'd made in Peru. And I said, well, did you make that in Peruvian currency or did you make that in U.S. currency? He goes, well, what do you mean? I said, well, unless you're retiring to Peru, you're going to have to, turn that back into money. It's a U.S. money at some point. Does Peru have capital controls, right? So you have that problem. You also have the problem that's the sovereign debt. The sovereign may default. Argentina, for example, or Turkey right now, both of them haven't defaulted, but they're close. And so while the interest rates you would get to buy a Turkish bond, Republic of Turkey or Argentinian debt, you say, wow, that's a great, coupon nominal yield. But then again, you got to take into account that they might default on that. We talked about inflation. We said inflation is too much money chasing too few goods. We said CPI is a measurement of inflation. Let's put that there. That's certainly something we need to know. And what they ask you on the test is what are called constant dollars. Constant dollars are dollars measured for inflation. So CPI is used to measure inflation. They don't test you on it's a basket of goods and services in a particular, city. They'd ask you it's used to measure inflation. Then constant dollars are dollars measured or adjusted for inflation. And this is a pretty simple test question. I told you there's only 6 questions here, but we don't know what 6 they are, right? So that's kind of the problem, right? Anyway, CPI is used to measure inflation. Constant dollars are dollars measured for inflation. So you might even give you a return or GDP. I say, for example, on the test, GDP is up 4% and CPI went up 4%. What was GDP in constant dollars? And you would say it was 0. So you just net the 2 returns. And we said stocks do better here. As an inflation hedge. And we said deflation. We said fixed income is going to do better. We said that's bad too. That's too many goods and not enough money. You get paid to sit on your money, right? If my money buys me more and more as I wait, and I'm going to delay purchasing things, and that's going to be actually more scary economically than inflation, right? So, but anyways, deflation, we said fixed income would be good. Let me get a different color. Interest rates. You're held accountable for 4 interest rates. So let's do those 4 interest rates you're held accountable for. You're held accountable. We talked about 2 of them already. And the 2 we talked about already were the discount rate. And we talked about Fed funds. What we haven't talked about is broker call. Broker call is what banks charge brokerage firms for money. And we haven't talked about prime. And so, that'll be an A, B, C, D. Prime rate is what banks charge their best commercial customers. Like this is what Facebook pays to borrow money, Apple, Google. I joke, this is what you pay to borrow money if you don't need to. So that'll be an A, B, C, D on your exam if you get that one. Let's talk about yield curves. They're going to test you on an inverted yield curve. So an inverted yield curve is not good. An inverted yield curve, well, let's get that going here. Inverted yield curve is when short-term rates are higher than long-term rates. And that is, test question, a negative leading economic indicator. So 2 test questions about an inverted yield curve. What is it? It's when short-term rates are higher than long-term rates. Test question number 2, it's a negative leading economic indicator. Credit spreads, that's the difference between, let's put that in here. Let's get a different color. That's the difference between what high quality bonds pay and low credit quality bonds pay. Lord John Maynard Keynes said money is like a giant floating crap game. It's going from one place to another. And so, you want to track this. And if we see that, for example, the difference between high credit quality bonds is widening and low credit quality bonds, that means people are nervous about the economy. And that means they're selling off their low quality buying, or excuse me, widening credit spread means they're nervous about the economy. They're selling off their junk bonds, causing the price to go down, the yield to go up, and their flight to quality, buying treasuries, causing the price to go up and yields to go down. So we see that yield gap widening. Again, that would be a negative indicator. And if we see it narrowing, that means people are comfortable. So a narrowing credit spread would be a positive economic indicator. Okay, so we talked about GDP. By the way, GDP is a coincident indicator. We talked about employment indicators. We said the Fed wants full employment, so they watch unemployment. We talked about the trade deficit. We talked about debits to the balance of trade and credits. Debits would be U.S. Imports. Credit would be U.S. exports to the balance of trade. We talked about the CPI. So let's talk about financial reporting. We said that's where we want to get in today's explication. We're almost there. And so what are the financial reports that we make? Now, again, it's kind of like economics. We don't know, which ones you're going to get, right? So we, have to be prepared for all of them. But as you see here, we have financial reports. So there's going to be 3. Let me get a different color. Let's call this things the issuer is going to report. So that's how we want to kind of do this thing. So issuers are going to, when we say a reporting company, that means a company that's public that reports to the SEC. And so the issuer that reports, a reporting company, public company, the issuer is going to file a report to the SEC, 3 10-Qs. 3 10-Qs. That's the quarterly reports. And those are due within 45 days of year end. Or excuse me, of quarters in. 45 days of the end of the quarter. Now, in those 3 10-Qs, We will take the chief financial officer's word for it. And then we're going to have a 10K. The 10K is the annual report, and testable distinction, that annual report needs to be audited by what's called a peekaboo accounting firm that is set up to do this. Now, what's going to be in the 10Q and the 10K are what are called financial statements. And the financial statements include a balance sheet, a picture in time as of, December 31st, 2020, for example. It's going to have an income statement. Based on the balance sheet, we're going to, in our next installment, analytical methods, we'll be talking about working capital and current ratios and, the quick ratio and debt to equity, some things we need to be prepared to do based on the balance sheet. That's not today's discussion. Today's discussion, last part of our time today, is about financial reporting that will be made by the issuer and a statement of cash flow. That's the money, the cash that comes in and the money that goes out of the corporation. It's very easy to fake a balance sheet or income statement. It's a little harder to fool an auditor about a cash flow because he could ask, well, where's the bank statement that shows this money coming in or going out? Right now, one other one that's filed by the issuer with the SEC, we're talking about financial reporting to the SEC, is an 8K. And an 8K is for a material current event. Like lawsuits. Somebody's filed a lawsuit for billions of dollars, or a disgruntled board member has resigned, some material current event. And we would make that within 4 business days. We're talking about financial reporting to the SEC, but remember this also, this 10Qs and the 10K are also going to go to the market center in which the stock trades, as well as to our shareholders. All right, so those are some things that the issuer is going to file, but we also have things that investors are going to file. So we have investors. Let's talk first about control persons. And control persons are officers, directors, and principal stockholders. A principal stockholder is somebody who owns more than 10%. And all that stock they own is called control stock. We're not going to let Larry Ellison call his broker and say, sell, billion shares of Oracle at the market. No. As a principal, a stockholder, well, I should say, to be proper here, I should say 10% or more. I don't think it's a big test deal, but there's a reason that a lot of people are going to take a strategic pause at 9.9. Because if they, go past that, there are going to be all kinds of rules that they're going to have to follow. And if you are a control person, you're going to have to, at or prior to sale, file Form 144. So regardless of where this control person got their control stock, whether they got it directly from the issuer, it's never been registered with the SEC because it didn't come from a public marketplace, or whether it's stock that they got in the public marketplace, doesn't matter. All that stock, control stock, they're going to have to file Form 144 at or prior to sale, and that's going to be good for 90 days. So Form 144 is good for 90 days. Now, what they're going to be able to sell is up to 1% of the outstanding stock, or the average of the last 4 weeks trading volume, whichever is greater. We're not really talking about the mechanics here. We're just talking about the financial reports. And then if they do sell based on that, they're going to have to file Form 4 within 4 days, within 2 business days. Okay, so that's for our control persons, our officers, directors, and principal stockholders, and the control stock, and that's the stock they own in their corporation. And then the other things we should be aware of is a 13D or G. 13 is active, 13 is G is passive. So, 13D might be a hedge fund, for example, and 13G might be Vanguard or Fidelity. We don't expect that the person filing a 13G is going to, try and take over the board. But so if they are, then that's a 13D. So more than 5%. And that's when it becomes everybody's business that they own this stock. And they're going to file that within 10 days. I wouldn't worry about the days like 45 days or 90 days or 2 days. What I would worry is just the forms that we're using on these financial reportings. There's 4 questions on financial reports that we make. Now, the other one that I would know and is pretty testable is 13F. And 13F is for an investment advisor. This is filed quarterly. An investment advisor who has assets under management of 100 million or more. Now, remember, this 100 million or more is testable at 2 levels, because remember, with 100 million or more, you can choose to be a federally covered investment advisor. I don't know of anybody who would choose not to. There's this gap between 100 and 110, but I don't know of anybody who would want to be a state covered. So these are typically federally covered advisors, and they're going to file this quarterly, with the stocks, the public stocks they own. So that's filed quarterly. Okay, so we talked about the income statement. We talked about the balance sheet. We talked about statement of cash flow. The auditor, remember, is going to say that, yes, whatever our CFO said, there's some basis in fact. And if, they disagree, they might not sign off on the financial statements. We said all this stuff is going to the SEC. We said the 10K has to be audited by a public company accounting standard board firm called a Peekaboo firm. Not a big deal. Don't worry about it. But you just can't go to a strip mall accountant and have this done. It's got to be done by, big time accounting firms. As we said, the 10Qs are not audited. They are unaudited. So the annual is audited, test point, test distinction, quarterly is not. And then we would also disclose whether we're using cash or accrual. And if we're using accrual, what is our method for that? Okay, well, I hope you find these explications helpful. We started this journey with these explications. To be honest with you, this is the first one for the 65, by the way. So please tell me in the comment box or wherever if you find it's worthwhile, because when we started the SIE was the first one we did completely. And, I said, hey, listen, if nobody finds this useful, we'll just hit the delete key and we'll be done with it. And as I said, there's lectures for all this stuff. I think what I'll probably do is when I put this in the playlist for the 65, I'll probably put the economics lecture right behind it, just so, if you want the actual lecture, that's available. And I told you shortly, I'll be back with analytical methods, as you see, as our next installment in this explication. So I will see you shortly with that. Like I say, like, subscribe, comment. We're pretty good at getting comment boxes. I'm not going to put this in a premiere mode. I'm going to put it in the instant availability mode. But most often, if you're a subscriber to our channel, premiere means we're going to have a chat, a live Q&A chat that runs with the lecture. And you can show up and ask any questions you like about any NASA or FINRA exam. So that's available for you. So if we get enough subscribers, we're closing in on being able to have on the channel a community page where we can actually communicate. Right now, we're communicating through, comment box on a video is kind of a pain, but it is what it is. So we also have if you want to remain anonymous and you want to, be able to ask questions, we also have a group. Let me put that up here. And I'm the moderator for that group. And that group is called R Series 7. It's a Reddit. And so feel free to join us there if you'd like as well. And there everybody's anonymous, except me. I'm Series 7 guru, and I'm the moderator, and that's disclosed. But everybody else is, who knows who they are. So, I don't know. I guess we should think of that as fun. Okay, well, I'll see you for the next installment, which is analytical methods.